Welcome to the IRS Solution Attorney Show. If you have problems with the IRS, don't focus on the negative, focus on the solutions. With the IRS Solution Attorney, Darrin Mish. For over 15 years, he's been helping taxpayers with IRS problems reclaim their lives and their financial stability. Now, here's your host of the IRS Solution Attorney Show, Darrin Mish.
Welcome to the IRS Solution Attorney Show. I am the IRS Solution Attorney, Darrin Mish.
And I'm your co-host, Katrina Madewell. Welcome back to the show this week.
How you doing, Katrina?
Doing good today, doing good.
I think there's birds chirping out there and bees buzzing. I think, have you noticed spring has sprung?
Yes.
It's amazing.
A lot of people may be off tomorrow because it's Good Friday.
Oh, yeah. I like that holiday. It's always good to have an extra Friday off, right?
Oh, yeah, absolutely. So this week's show is right on time because last week's show was tips for millennials.
Yeah,
this week's show,
I wanted to make sure that pretty much everybody was covered. I think last week we went over millennials covers from age 12 to 35. Which
we
is
had to look up the age for millennials.
It seems like a really, really big block of time. Well, today's show is about tax breaks for people, specifically over the age of 50. And I want to tell you this, okay? I don't actually quite qualify for this. Any of these tax breaks, actually, because I haven't quite hit 50, but I'm getting closer.
You're right in the middle. You're middle-aged?
Yeah, I'm in that.
Are you going to kick me if I say that? My husband does not like that term, middle-aged.
I got to tell you, when I turned 40, I just about freaked out. I almost had a midlife crisis. I mean, it took me 2 years to get over the fact that I was, in fact, no longer, what society deems as young, and I was now middle-aged. And it was just depressing, but I eventually got over it.
Well, it happens to the best of us, unfortunately.
So, one of the things that's really good for, that are people that are getting a little bit older is they have a bigger standard deduction. You even know what I'm talking about?
No, I have no idea because I'm not anywhere near that age. And in fact, you are older than me, so I don't know what that is.
Oh, you just had to put that in there, didn't you?
I have to make this show fun. You're talking about IRS stuff after all. Come on.
Well, when you're thinking about hiring an attorney, don't you want a seasoned attorney, somebody who's been around the block a couple times, or do you want that kid that just came out of law school?
When you say seasoned, I think salt and pepper, and you don't quite have enough in your hair, so...
I actually think of Lowry seasoning salt for some reason.
You do?
I mean, it must be good marketing.
Okay.
So anyway,
bigger standard deduction.
The standard deduction for most folks is somewhere in the range of $6,300, I think, at this point in time. But the standard deduction for taxpayers age 65 and older in 2016 is going to be $7,850.
So why is there a standard deduction?
Well, the standard deduction is because most people aren't going to qualify to itemized deductions, right?
We talk about people that are entering retirement age.
We talk about itemized deductions all the time on the show, and let's just kind of briefly recap what it actually means. Itemized deductions are those things like mortgage interest, sales tax, points on your mortgage, property taxes, those types of things. So when you're preparing a tax return, you have a choice to either take the standard deduction, which in this case for people over 65 or older is $7,850, $7,850. Or if your itemized deductions add up to more than $7,850, then you're going to want to go ahead and itemize. But in this case, there's going to be a lot of people age 65 and older that are maybe renting, or maybe they don't have large mortgage balances anymore, that itemizing is not going to make sense. And so the IRS, the government, for whatever reason, thinks that people, over age 65 need an extra tax break, and they give them just a little bit higher standard deduction.
I really don't even know why they are required to file, to be honest with you. It doesn't make sense to me, but...
Well, I don't think you're saying that if you got to age 65 that you shouldn't have to file a tax return.
That's exactly what I'm saying.
Well, that's interesting. We ought to bring that up in the prepresidential election coming up. But
I'm just saying, I think if you've done it your whole life, why should you have to file taxes when you're old or retired? I mean, you should have given a break from everything. That's just my opinion, but,
I can't say I disagree with you. I kind of like the idea, but I think what comes to mind is people who are living on a fixed income, like Social Security only. Right. They don't actually have to file, but if they have a certain amount of other income, in addition to their Social Security, they actually do have to file.
Not to hijack the show and go in a different direction, but when you think about retirement, like for me, I think about getting away from the daily grind, like all of it, everything from answering the phone to responsibilities, to itemizing, to shoebox receipts, to everything, even filing taxes.
It's funny, when I think of retiring, I think of being on a sailboat in the Caribbean and not worrying about anything.
Well, that goes with it, but you're not doing any of that, and that's the whole point.
Yeah, for whatever reason, there still is a filing requirement, even if you're over age 65, if you in fact have the income that requires you to do so. So there's just a little bit of a break.
So that might change somebody from last year to this year. So that's a good point because the standard deduction's larger.
Right. And for married couples, the standard deduction climbs by $1,250 for each spouse who was born before January 2nd, 1951, or $15,100 if both spouses are age 65 or older. So there's some, really the point of the comment is, if you're over age 65, even if only one spouse is, you're going to want to make sure you check that and make sure what, maybe your standard deduction might be a little bit higher than you're typically accustomed to.
Okay, so the next tax break we have for people that are 50 or older are higher tax filing thresholds.
Yeah, this goes back to the point I was making about if you have Social Security income and you have, another job. It was actually Clinton who passed a law during his administration that said that, that you could start losing some of your Social Security benefits. You don't really lose your Social Security benefits. You start paying tax on some of your Social Security benefits after a certain income threshold. And so...
Yeah, that's debatable considering they keep moving the age back.
Oh, for sure. By the time, I'm ready to retire, I'm sure that...
It's like doing a 5K and they just keep moving where the finish line is. It's ridiculous.
Turns into a 5.5K, a 6K, a 7K.
You're going to be 90 before you can collect Social Security benefits by the time I retire.
I think I'm not quite 50, and I think that by the time I get to retirement age, it'll probably be around 70, which, there are some arguments that makes sense. One of the arguments is... They don't have
any choice because they're out of money.
Well... Back when Social Security was put into place, that was during FDR's administration, and it was set up so that at age 62, because the actuarial tables said that people were going to die by age 65. And so it was set up so that it was a short-term sort of solution to your very old age, because medical care had an advance to the point that it is now. And I think the average age lifespan for a woman is like 84, and I think it's around 79 for a man. And so Social Security benefits have been going on longer and longer than ever were anticipated.
So
I am not in favor.
This is a short little plug for my guest next week, if you don't mind. Tatia Berry, she's a holistic life coach, and this goes
that's
right
actually
on
really
track.
Cool. I didn't do that on purpose.
So if you like this, tune in tomorrow at 9 a.m.
Yeah, so anyway, I'm not saying that the age for Social Security benefits should be extended to be older, but it does sort of make sense, and it's actually a solution that probably would solve the fact that Social Security is broke. So anyway, there's a higher tax filing threshold for people that are age 65 or older. They can earn a gross income of up to $11,850 or $23,100 if both couples or both people in the couple are age 65 or older.
So they do have the option to not file a return, but you have to be below the poverty level pretty much.
Yeah, well, and that's not that uncommon. There's different...
Especially for the boomers. They're notorious for partying and not saving any money.
Well, in retirement age, there's, the Walmart greeter or the guy working at Home Depot, 4 hours a day might not be hitting these thresholds, and he might have a pension and, Social Security or whatnot. And so it makes sense that... That's true. They shouldn't have to file a return. I talked to somebody
yesterday when I was in the phone store. He said 15 hours a week is considered enough time for benefits. So I could see that.
Wow, that's really low.
Yeah. And so let's move on to number 3, which is property tax breaks.
Yeah, there can be some property tax breaks depending on your state and your jurisdiction. There are some places where if you're over 65, you actually could get a tax break and pay lower property taxes. And that kind of makes sense, too. People that are over age 65, aren't going to be having kids in school, and they're typically not going to be using as many services, potentially, as younger people. So it does make sense. You're going to want to look that up, and that's going to vary state by state and
income by income and a lot of details.
Municipalities and things like that.
All right, so number 4 on our list is 401k catch-up contributions. That's a great one. We'll probably talk about this one for a while.
So workers age 50 or older can contribute an additional $1,000 to an IRA for a total of $6,500 in 2016. So a 50-year-old worker in the 25% tax bracket who maxes out his IRA would save up to $1,625 on his current tax bill by doing that. So it does make sense that, what they're trying to do is they're trying to allow people like me who potentially haven't been taking advantage of their retirement accounts to their maximum, put a little bit more money in there so that they can have a little bit more money when the time comes.
But this shows for people 50 and older. So does it apply to them? No.
Yeah, it's actually for people that are 50 and older. So it doesn't count for me yet, but it will soon.
That's when you're planning to finally start saving for retirement? That's good to know, Darrin.
I have been saving for retirement. It's just not in the traditional
not the way
kind of
it
ways.
should be?
Yeah, I'm actually more in real estate and things like that.
I'm all about that. Like, that's,
That's
my retirement plan.
Exactly. I expect you to say
It makes sense, It's about that time. We have to take a quick break, so stick around. You're listening to the IRS Solution Attorney Show with Mr. Darrin T. Mish. I'm your co-host, Katrina Madewell. Today's show is all about tax breaks for people over 50. Stick around. We'll be back in just a minute. Welcome back. You're listening to the IRS Solution Attorney Show with Mr. Darrin T. Mish.
That's me.
I'm your co-host.
I'm actually the IRS Solution Attorney, and you're my co-host.
I'm the sidekick, Katrina Madewell.
You are actually fabulous. You help me come in and out of breaks. You're always interesting to talk to.
Nice to be called fabulous. I love it.
I appreciate that you're here helping me with this.
Oh, you're welcome.
Day in and day out. Actually, week in and week out.
See, the best part about me being on the show is I can say the stuff that attorneys can't say.
Well, there's another part, too.
What's that?
Your commercials play during the breaks, right?
Yeah.
So that's pretty good.
Well, aside from that.
I think you're a real estate agent extraordinaire.
That's right. Somebody's got to know this stuff because most of them don't.
This is a very true statement, actually. So in the last segment,
back on track,
we were talking about...
And the topic for today's show
is tax breaks for people over 50.
Yep.
Not that there's anything wrong with people under 50.
But last week was millennials, so this week's you guys.
Exactly. And at some point, we're going to have to do a special show for people between millennials
middle-aged
and 50. Middle-aged people. I don't know. The 36-year-olds might not think they're middle-aged yet, you know?
I don't think I'm middle-aged, but, some of my husband says because I tease him. He's middle-aged, so.
Okay, so we're not clear on how old you are, and we don't need to know that. But anyway, now.
I'm just young.
In the last segment, we were talking about additional IRA contributions. So
if you missed any part of the show, we talked about a lot of stuff, actually, and the whole show is available on a podcast. Just search for the IRS Solution Attorney. IRS
Solution Attorney on iTunes, or you can visit our special podcast-only website at irssolutionattorney.com. And, of course, you can always access them at my regular website at getirshelp.com.
And if you do have an IRS tax question, you can reach Darrin T. Mish at 888-GET-MISH.
That's 888-GET-MISH, 888-GET-MISH, or 888-438-6474 if you are the type of person like me who does not like to spell out things on a telephone keypad.
Like dish, but mish.
Yeah, exactly.
He prefers fish, but
it's very
mish.
simple. M-I-S-H. If people want to put a C in there, they want to make it complicated. It's really not all that complicated.
But we were talking about some of the things like the bigger standard deduction because that was changed for this year. Also talking about higher tax filing thresholds, property tax breaks.
There's a lot of these numbers that actually move a little bit every year, theoretically, because the price of living goes up, the cost of living goes up. And so we were talking about the additional IRA deduction. You get an extra $1,000 if you're 50 or older. You can put it into your IRA.
The 401k catch-up.
Yeah, there's a 401k catch-up contribution. It's not the 401k mustard contribution.
That's what I was thinking. They should call it mustard. I swear, I think you're reading my mind now.
Okay, quick sidebar. What's up with the spelling? I mean, I get ketchup with a K, right? But you ever go to the store and you see catsup?
Yeah, catsup.
What is that? Is that even popular anymore?
It's probably a European spelling or something.
I think it's probably Midwestern. They do things different in the Midwest. Have you ever noticed that?
I don't know. If I was the Heinz 57 era, I probably would have an answer for this question. But I'm not.
Or another condiment issue is Heilmann's mayonnaise is called Best Foods west of the Mississippi, or west of the Rockies, actually. Why?
Never heard that one, but then again, I'm not from west of the Rockies. You are.
They couldn't get Heilmann's over, the pass in the Rockies, or what's the deal? I don't get it.
Probably donkeys and mules and horses back then, so it's possible.
Okay, so anyway yeah, if you
we have to make this stuff fun,
Talking about the 401k catch-up contribution,
so if you didn't save enough money
for
retirement, you got to start catching up. Hopefully by this point, maybe your house is paid off or close to it, or your expenses has dropped down. You don't have kids. You can pay some extra money towards your retirement.
How wonderful would it be to have a paid-off house by age 50 where these rules start to kick in?
My house would be paid off well before 50.
You can actually defer paying income tax on $6,000 more in your 401k contributions than if you're under the age of 50. So that's really a good thing. You can actually put up to $6,000 more in your 401k.
If you're over the age of 50.
If you're 50 or over. So I guess over the age of 50 is like 50 plus a day.
Sometimes you run through these numbers so quick, my eyes glaze over. So you got to repeat it again.
Yeah, so you can actually you can defer paying income tax on up to $6,000 additional if you're age 50 or more. So that's a pretty good deal.
And so the total amount, is it $24,000? Is that right?
Yeah, it's $24,000, and that could save you, up to $1,500 a year if you're in the 25% tax bracket. So that's a pretty good deal.
And you'll have some extra money for retirement, which is kind of the whole point.
And I wasn't actually aware of that before I started doing research for the show today. So that's pretty neat. And some of these things are going to start kicking in. I really never thought about turning 50 before, but I got a year or so, and I'm going to start taking advantage of some of these things. I actually need to set up a 401k at the law firm because I don't. And some of those things can be really tax advantageous by...
Well, if you're the only employee or if you have limited employees, you can offer the same match plan for everybody.
Yep. Or you can just set up another corporation that does something specific where you're the only employee.
Yeah.
And then you can set up matching for everybody.
Absolutely.
Yeah. Yeah. The problem is you have to have some other idea on how to start up another business. But anyway...
Hopefully you got that, Darrin.
So, early withdrawal penalties.
So when do they take that away? There's no more early withdrawal penalties?
At age 59 and a half. And that kind of reminds me
59 and a half. Yeah. Like, do you have to wait to the day or the minute, or what's that all about?
Yeah, it kind of reminds me of, in most states, you have to be 15 and a half to get a learner's permit. Do you remember that? Was that how it was?
No, it's always been 15.
So I grew up in California, and literally you could get a learner's permit at age 15 and a half. And they literally, there's a date that's in the half a year. I think it's 183 days. So that's when you're and a half. So same thing here with the early withdrawal penalty. If you're 59 and a half, then there's not going to be an early withdrawal penalty. Of course, if the retirement account is taxable, you're still going to have to pay taxes. You just won't have to pay that dreaded 10% early withdrawal penalty.
Yes.
If you're over 59 and a half. And I've seen cases.
Don't they get like double taxed on that? I think we've talked about this before because they get hit with a 10% penalty, but isn't there extra like taxes or fees or something?
Yeah, if you're talking about a traditional IRA as opposed to a Roth IRA, and we'll talk about the differences in a second. If you're talking about a traditional IRA where you're paying taxes at the time of the withdrawal and it's an early withdrawal, then you're going to pay the 10% early withdrawal penalty plus the income tax rate of whatever that withdrawal, whatever bracket that puts you in. So
they're taxing you as income on that $10,000 or $20,000 or whatever you took out.
Yeah, and usually with my clients, it's like $100,000 or $200,000. In fact, I just talked to...
that's a hefty tax. Like, what does that shake out to at the end of the day? Like, more than 25%, doesn't it?
Well, let me tell you a story about a gentleman I talked to yesterday. He actually made what was characterized as a hardship withdrawal. And there's a lot of these plans, you can take out a hardship withdrawal for the purchase of a primary residence. So a hardship withdrawal sounds like it's a hardship, therefore you wouldn't have any penalties or potentially not even have to pay any tax on it, right? I mean, hardship is one of those words where we're like, okay, I'm going to have a hardship, so I should get cut a break. So he makes a hardship withdrawal of, I believe, $108,000, and he moves down to Florida from somewhere up north, and he buys, $500,000 house, and he was thinking there was no early withdrawal penalty or tax. And his tax preparer does the tax return. Turns out he owes $23,000. And he's like freaking out because he's like, but it was a hardship withdrawal. Well, yeah, it was a hardship withdrawal. It meant that you could technically take the money out of the account because you have to have a decent reason to take the money out of the account
without
at all.
That 10% penalty?
No. He ended up, although it was a hardship withdrawal, which meant that he was entitled to withdraw the money from the retirement account. So that means they
let you take it. It doesn't mean you are escaping the taxes.
That's exactly right. That was the point I was trying to make, is that, yeah, it's a hardship withdrawal, meaning you can actually access your money, but you're still going to have an early withdrawal penalty and have to pay the tax as well. And so probably
That's
what happened.
Excellent point.
Probably what happened to him was, he was already making $100,000 or something, and then when he took out another $108,000, it kicked him into probably the highest bracket, and that's where it started to really add up. He was pretty upset about it.
That's a sore subject in my house too. That happened to us one year.
Yeah, we ended up making talking about a plan to like push that off so that he wouldn't actually have to start making the installment agreement payments for about a year. So he's pretty happy with that plan. I mean, he wasn't happy he owed the tax.
Have you had customers like that you've helped them escape that tax or figure that out for less than what they want to penalize them?
Well, in the law biz, we don't call them customers. We call them clients.
Yeah.
So, yeah,
customers, clients, people.
I have had some clients. I'm just teasing. I'm just playing with you. What was the question again? I was too busy correcting you.
Oh, my gosh. So the question was, have you had any IRS tax problems where they got penalties and income taxes and all this stuff on the early withdrawal from the 401k.
Oh, yeah, all the time. Yeah, that's probably one of the most common ways that a wage earner or a retired person is going to end up with, a big tax bill. Probably not a retired person, right? Because they're not going to have an early withdrawal. But sometimes you see retired people who, sure, they're over 59 and a half, so they don't have the 10% early withdrawal penalty. But let's say they had 400 grand in their retirement account, and one year they just go hog wild crazy and they take 100 out, and they're not thinking about, wait a minute, that's a traditional IRA. I got to pay the taxes on that, and that kicked me into a different tax bracket. So one of the strategies that you can use in dealing with that is if you have a big expenditure, you can go ahead and take out, if you're kind of at the beginning of a new year, you can take some of that money out in December, some of that money out in January, and you can disperse that, spread it out over 2
Hold
tax
that
years.
thought. We're going to recap that when we come back in just a break. You're listening to the IRS Solution Attorney Show. Stick around. We'll be back in a minute.
Are you suffering from IRS problems? Do you owe back taxes you can't pay? Is your paycheck or bank account being levied? Or maybe you haven't filed tax returns in years and simply don't know what to do. This is Darrin Mish to tell you that if you're tired of IRS problems hanging over your head and are ready for a fresh start, we may be able to help. Call the law offices of Darrin Mish at 888-GET-MISH, 888-GET-MISH. I can help you file old tax returns, work to release tax liens or stop wage levies, even negotiate deals to pay off back taxes at a discount, sometimes for pennies on the dollar. Hey, let's face it, these days it's not hard to get into tax trouble. A divorce, failed business, health problems, you name it. The point is, IRS problems may be solved if you're willing to take the first step. Call for a free consultation at 888-GET-MISH. That's 888-438-6474. Or go to the web at getirshelp.com, because the one sure thing is, IRS problems don't solve themselves. So get Mish. 888-438-6474. Principal Office, Tampa.
Breaking rocks in a hot sun. I fall below in a low one. I fall below.
Welcome back. You're listening to the IRS Solution Attorney Show with Mr.
Darrin Mish, the IRS Solution Attorney.
And I'm your co-host, Katrina Madewell. Thanks so much for sticking around with us through the break. Let's recap on that because I feel like we kind of ran out of time for what we were talking about. The question was, I asked you if you got clients that came in and actually got hit with that 10% penalty, and you were talking about them getting bumped into their tax bracket. Can you just recap on that?
Yeah, so sometimes, if you have a retired person that has a traditional IRA, so they're going to have to pay tax on the withdrawals. So they're not going to necessarily pay the 10% early withdrawal penalty because they're over 59 and a half, but they're going to have to pay the tax. Let's say they need to withdraw 100 grand because they know they have some big expense, like they're going to buy a house or something like that. If you're toward the end of the year, one strategy that can be really intelligent is to go ahead and take out some of the money in December and take the rest of the money out in January. And I mean, that could be literally 1 week, right? Take some of it out in the last week of December and some of it out in the first week of January. And that would actually spread that withdrawal out over 2 tax years and potentially lowering your overall tax bill because you could stay in a lower tax bracket.
Instead of throwing them up into the next tax bracket.
Yeah, exactly. So let's talk real quickly about the difference between a traditional IRA and a Roth IRA. A traditional IRA is what we think about traditionally when we talk about an IRA. It's where you have certain contribution limits and you put money in there over time. And because you're putting pre-tax money in there, when you make the withdrawals, they're actually taxable at the time of the withdrawal, which makes sense for lots of people.
I think you're glazing over this a little bit too fast.
Okay.
So traditional IRA, and a lot of CPAs may suggest this so that you can get a tax break during your earning years. But you're taking that tax break now, and you're going to have to pay taxes on it later.
Right, and for most people, that makes sense, right? Because during their working life, they're going to be in a higher tax bracket. And so let's say, I don't remember what the contributions are for IRAs right now, but let's say you put
it depends on your age and your income, I think.
$2,500 in there. Then that's going to be $2,500 that you're going to deduct, and you're not going to have to pay tax on that money now during your working life. With the theory being that you're going to put that in some kind of account, it's going to grow and whatnot. And then when you make those withdrawals, when you're older, you're going to have to pay tax, but you're going to be in a lower bracket, and so it's going to be a tax advantageous sort of situation.
I personally prefer the Roth, which is I know what you're going to chat about next, and it's also what Dave Ramsey recommends because you don't pay taxes on all that growth.
Yeah, Roth IRAs are really cool. There's income contribution, or there's income limits to where you can't even open a Roth IRA after a certain income limit. But a Roth IRA is kind of neat because you're going to put after-tax money in the IRA, which kind of sounds bad, right? Because you don't get a write-off when you put the money into the Roth IRA. But the really neat thing about Roths are that at the time of retirement, after you have all that growth and appreciation and accumulation, you're not going to have to pay tax on those withdrawals in your older age. So it's really good for higher income people or people that anticipate being higher income during their retirement age.
So number 6 on our list is avoiding tax on required minimum distributions.
Yeah, this is kind of interesting, right? I mean, we very rarely think about, hey, you actually have a minimum you have to take out of your retirement accounts. So when you hit age 70 and a half, there's that half year again. I don't know what's up with that. But so when you reach age
only the
70,
IRS could write this
70 years and 183 days, you typically you have to take out a minimum amount of money from your traditional retirement accounts, and then you have to pay the resulting income tax bill. So there's a formula that there's a certain percentage you have to take out and whatnot. But one kind of interesting and cool strategy is you can actually take that money out, contribute it to a charity of your choice, and then you're not going to have to pay the income tax on that charitable contribution. So that's really for really wealthy people.
But I guess the IRS's thought is to keep money moving through the system, right? The economy. You think that's what it is?
I think the rationale is probably to keep really large transfers of family wealth from happening. I think that's probably the reasoning, and I'm not really sure why they care, but at some point they don't want that money locked up, in institutions. I guess they want you to make, your withdrawals and pay your taxes. I guess that's really probably the issue, is they don't want rich people just sucking money away and not ever taking it out.
Well, because there's a way to transfer money to your kids without that being taxed.
Sure, but not necessarily out of, withdrawals from your IRA.
Yeah, there's so many quirky
from
little
your
rules.
retirement account, right?
So number 7 on our list is higher HSA contribution limits. So HSA is health savings account.
Yeah, and I'm really a big proponent of health savings accounts. I actually love these things.
It took me a long time to get this one, but we got it.
Yeah, we have one, and we've had one in my family for going on a better part of a decade now, actually 12 or 13 years, I think. What it is you have a high deductible health care plan, kind of like what Obamacare requires, right? So you have it in our family. I think our deductible is $68.50, a year. So nothing is covered except for like well care visits,
Basic.
like physicals and stuff like that. Nothing's covered, up until you get to the point of $6,850. Now, the cool thing is that you're allowed to put pre-tax, kind of like a Roth IRA. You're allowed to put about 60.
So if you're getting $5,000, yeah, you could take out, $5,000 a month. You could take out a certain amount, $5,000 or $6,000 a year.
Yeah, it's about $68.50 a year, I believe, for 2016 for a family. And so you can put that $68.50 into your health savings account pre-tax without paying any tax on it. And then for qualified healthcare expenses like doctor copays, dental cleanings, prescription drugs, some over-the-counter drugs, I already said
anything healthcare related. Like I get
contact
migraines.
lenses, vision, vision care, those types of things. That's all. You can pay for all that stuff out of your health savings account, which is pretty cool. And it also has another benefit that people don't typically think about, and that is that doctors will actually bargain with you. If you're paying cash, which you're going to be paying cash up to the deductible limit, then all you have to do is go into the doctor and say, "Hey, doc, what's this going to cost me?" And typically, the doctor has no earthly clue.
I don't know. Ask my assistant.
And yeah, so what happens is you talk to the billing person, and they'll traditionally or routinely cut that bill by sometimes 60% because you're going to pay cash, today, or you're going to use your debit card from your health savings account today. And the reason that I think they do that is because they don't have all that billing expense.
Right. And they have negotiated amounts anyway already.
Yeah, with all the HMOs and stuff anyway. So you're getting the benefit of getting the HMO screaming discount rate. And you're making your healthcare dollars go farther. I really do, and I've said this before, I really do think that health savings accounts are the solution to healthcare expenses in this country. And the reason that they are is because when it's your money, you care how much things cost.
Right.
When it's health insurance companies' money, you don't care what it costs. And you probably, frankly, never even see how much it costs.
That's true.
Because it's just not really, you feel like it's not your problem. You're entitled to whatever coverage, and you're just not going to care. And
you actually might have some people that would possibly run to the doctor less and that kind of stuff if it was their money.
You think if they actually had to pay?
Yeah.
So within the past few years, I was having some kind of, complaint, healthcare complaint. And I went into the doctor and he says, well, we really should run this test. And I said, really? So what are the odds that this test is going, that I'm going to have this thing, this malady, based on this test? He says, oh, it's extremely slim. We're just doing this to cover ourselves. I said, well, how much is it going to cost? It's expensive. Okay, doc, we're not doing that because it's my money. I don't need to know. It's not that. It's not like some rare tropical disease. I haven't been to the Amazon. Let's not do the test. But if you had health insurance.
Sometimes I think they push for it and they ask for it. Like it's like they're almost like they're upselling insurance.
I don't really think doctors are doing that. I think it's more they're afraid of litigation, especially when their patient's a lawyer.
Yes.
So I signed something that said, I don't want this test, basically because I don't want to pay for it. But, that covered him.
People are more guarded with people like you anyway, Darrin, because people are so sue happy.
Yeah, I probably get more time with the doctor and the dentist and stuff than your average patient. And it's not because I demand it. It's just because they probably look at the occupation thing and kind of figure that I'm not a nice guy or whatever. So anyway, when we're talking about HSAs in the context of what we're talking about today with older folks, there's actually a little bit higher of a contribution that you can make if you're 55 or older. So you can actually contribute like $1,000 more per person into your health savings account when you're a little bit older. Another really cool thing.
That's a neat little tip, and for sure that older people are going to have more healthcare expenses. They just do. It's a fact.
Yeah, another really cool thing about the health savings accounts is that if you reach age 65, of course, Medicare kicks in then, right? So you don't have a need for traditional healthcare insurance at that time. But if you have a pot of money in your health savings account, it actually turns into an IRA.
If you're older?
Yeah, when you hit age 65, if you have money in your health savings account, it actually turns into an IRA.
I did not know that because when you're younger, you lose it. It's like use it or lose it.
Well, I think what you're talking about is a flexible spending account.
Oh, yeah.
And what I'm talking about is a health savings account. So you don't actually lose your health savings account money ever. It just rolls over year over year. In my family, we have a family of 4 and 2 kids and whatnot, and we don't ever have any money in the thing at the end of the year. But it's kind of nice. What it does is, in effect, it makes all of my family's out-of-pocket healthcare expenses deductible.
Well, you can budget for it, too. That's the cool thing about it.
Yeah,
you can budget for any mishaps or regular doctor-type visits.
Yeah, pretty much everything above a broken arm is going to be covered by, your policy. I don't think a broken arm costs $7,000.
Well, we finally did flexible spending after spending several years back to back in the hospital with kids, between mastoiditis and, broken noses and you name it.
Hold on a second. Now, What is mastoiditis? Is that where you turn into a mastodon?
No, it's literally, it can affect your hearing bone. It's an infection that's so bad in your ear, it's very painful. It can affect the hearing bone.
So it's like
if we didn't go to the doctor soon enough, Nicholas could have lost his hearing.
Well, I'm glad he did it.
Me too.
Yeah, absolutely.
But it was crazy. It was really bad. It was so bad that ear, nose, and throat sent us directly to the hospital and scheduled surgery the next day.
Wow.
It was crazy.
They admitted him to the hospital.
And it was around this time of year, so we went in, my husband and my son's birthday are 3 days apart, and they fall all around Easter. And I think we went in on my husband's birthday, was there for Nick's birthday, came out, it was past Easter, we spent Easter in the hospital. It's kind of crazy.
Does he swim in lakes by any chance?
He has, but he'll get it even just from going in the pool.
Yeah,
some kids are just more prone to ear infections.
Yeah, my kids get it if they swim in the lake a lot. Then they end up getting ear infections and ear problems and stuff.
So number 8 on our list is lower the threshold to deduct medical expenses.
Yeah, so most taxpayers can only deduct their medical expenses on their tax return if those expenses exceed 10% of their adjusted gross income. So let me give you an example. Their adjusted gross income is $80,000. Seems like a reasonable number, right? Well, they can't even deduct their medical expenses on Schedule A as an itemized deduction. Didn't we talk about that earlier in the show?
Yes, we did.
Okay, so they can't even deduct those medical expenses until they reach the level of $8,000 in my example. So it's got to be at least 10% of their adjusted gross income, or they're not deductible at all. And this is actually a pretty commonly audited item. And the reason is that's kind of a rare thing.
Yes.
Right? So the bottom line is if you're 65 and older, you can actually deduct your medical expenses even if they're more than 7.5%. So you get a little bit of a
we'll
break
recap on this in just a few minutes. We have to take a quick break. You're listening to the IRS Solution Attorney Show. Stick around. We'll recap in just a second. Back in a minute. Welcome back. You're listening to the IRS Solution Attorney Show with Mr. Darrin T. Mish,
the IRS Solution Attorney.
And I'm your co-host, Katrina Madewell. Thanks so much for sticking around with us through the break. Today's show is all about tax breaks for people over the age of 50. And we actually had a question from Joe. He wanted to know, he was listening to the show on the road, like a lot of people listen to talk radio. They're in and out of the car, and he wants to know where he can find all the episodes to the podcast.
There's actually 3 places. You can find the podcast on iTunes under the IRS Solution Attorney Show.
Just search, pops right up.
Right.
Or Android people too.
You can go to our special website for the podcast, which is irssolutionattorney.com, or my regular website is getirshelp.com, and they're on there as well. So there's lots of places to find, back episodes of the show. And we try to have a topic that we talk about, every week that is of some value to, our audience.
As relative, let us know. We're really curious to know what you think about the show. If there's something you want us to cover, we'll be happy to chat about it. Just hit us up at 888-404-1010, or feel free to reach out to Darrin at 888-GET-MISH.
That's 888-GET-MISH, 888-438-6474. So at the end of the last break, I kind of glossed over, went too fast, ran out of time because I'm not the radio pro here like you are.
Yeah.
So typically, taxpayers under the age of 65 can only deduct their medical expenses if they exceed 10% of their adjusted gross income. So in my example, if your adjusted gross income was $80,000, then your medical expenses would have to exceed $8,000 in order to itemize them, deduct them on Schedule A. Okay?
Gotcha.
So the break is if you are over 65, then that threshold reduces to just 7.5%. So it gives you a little bit of an opportunity.
That's nice.
And, most
that
people...
makes sense because they might have more expenses than that amount.
It does, but on the other hand, aren't most people over age 65 covered by Medicare anyway?
Yeah.
So the odds of them actually probably having those medical expenses are kind of on the rare side. But it's a nice, thought that Congress threw them a little bone to try to help, the senior citizen set. And I think that that's good.
I'm sure there's somebody that it's going to help for sure. So there's a headline we want to chat about because it's right on time, right, for it being March Madness. But one of our stories is the road to the Financial Four is paved in tax evasion.
Man, you really blew that. It's the road to the Final Four is paved in tax evasion.
Thanks for cleaning it up. Somebody's got to screw it up. Usually that's you.
And the point of the story here is that, March Madness office pools, which are super common right now at this time of year, that's technically illegal gambling in most places.
Ouch.
So that's
kind of like a football pool?
So, we have 2 issues, really. We have illegal gambling, right? So I've actually heard stories of cops busting doors down to arrest old ladies, playing bridge. And I shouldn't have said old lady. That's really not nice. Older
bridge.
women who are playing bridge, and they bust down the doors and arrest the ladies. And come on, this is silly. There's real crime.
So are
going
they
on
really looking for people that are doing this?
Well, no, not really. But the person who wins the pool, let's say in a big building like we're in right now, and there might be 100 people in the pool. The winnings might be $5,000, right? And there might be a little bit of office jealousy. And theoretically, if you don't put that on your tax return as gambling winnings, it's lower.
Do you think
down.
they're scouring any of the social media sites for that stuff?
I don't think they are now.
Yet?
But can't you see that coming?
I can see it coming.
You
I'm surprised they haven't started.
You could write a script for that, probably to just scrape, Facebook and stuff, and then match the Facebook account to the tax return.
They'll hire some techie 20-something to do that.
I don't think at this point in time they have the capability to do that, but I can see that maybe by 2020, 2025, something like that. You just have to be careful, You hear stories and see stories all the time about people doing, illegal knucklehead kind of things that we used to do when we were teenagers, frankly. But we didn't have cameras in our pockets, and
so much stuff is on social media. That's why I asked that, because I'm not up to speed.
Man, I am so glad that the internet did not actually exist when I was a kid, because there'd be a record of all the silly things that I did.
We talked about that. So it's about that time.
It is, in fact, about the time for the IRS train wreck of the week. I really am happy about this one.
Okay.
It's this gentleman is really,
we talked
really
about
nice
this
guy.
last week. I couldn't wait for it.
Yeah. It's a little bit unusual. It's not unusual. He's a truck driver, right? It seems like every 5th show, my client that had a good result was actually a truck driver.
They're either truck drivers or realtors every week.
And I think it's because
or
truck drivers, owner-operator truck drivers, by the way, are the backbone of the American economy. Everything in this big studio that we're in, every single thing came here on a truck from somewhere.
That's true.
It probably originated on a ship from China, and then it ended up at a rail yard. It might have gone on a train, but bottom line, everything ended up on a truck before it got to the user. So this gentleman was an owner-operator, and he had not filed tax returns for a lot of years. In fact, I have it written down because it's so darn impressive. 1993, 97, 98, 99, 03, 05, 2010, and 2012.
Wait, so that was 1, 2, skip a few? Like he literally filed some returns in between? Is that what I just heard?
Yeah, and that's not uncommon. That's why I wrote it down, because
Okay.
it's a long stream of years, but it's not a continuous stream. There were some years got paid, some years didn't, some years, he just didn't have to file because of the 6-year rule that we talk about all the time. But he amassed a very large tax debt. It was $234,516. I mean, exactly at least to the dollar.
Was that all of them combined, or
It was
a few
all
years?
of them combined.
Okay.
We went ahead. Then they were actually levying him when we filed the offer. And
Talk about levy. What does that
a
mean?
levy is where the IRS was garnishing his wages. Actually, I think it was his Social Security in this instance, because he was an older gentleman. And
So swoop your money.
they didn't actually stop the levy. And I wasn't aware that they hadn't stopped the levy. Okay. And he's a really nice guy. He just never said anything about it. So we get the offer done for $1,200. So $1,200 on $234,516. Really, really good deal.
I'm going to start calculating percentages on these things.
Yeah, last week we were at about 11 cents, I think, and I don't know. This one looks like 3 or 4%. I mean, it's really low, and that demonstrates that there's no absolute threshold. It doesn't really matter what the percentage is. It matters what we're able to demonstrate. The math calculation is, and we don't have time to go over what exactly the math calculation is, but. The interesting fact in this case was when the offer was accepted and paid, they were supposed to automatically stop the Social Security levy, and they didn't. And I didn't know. So my client calls me back maybe 3, 4, 5, 6 months later, and he goes, "Hey, Darrin, you did a great job. It was awesome. Thank you so much."
Are they finally going to stop taking my money?
Yeah, he says, "Are they going to finally stop levying me?" I'm like, "What?" He says, "Well, yeah, they've been levying me since I, first talked to you, and it's never stopped." I said, "Yes, they are.
You
We're going to get that
should have
stopped."
told me that.
So we ended up going through an independent agency at the IRS called the Taxpayer Advocate. We got the levy stopped. And the cool thing in this case is we actually got a refund for all the levied monies from the time the offer was accepted until the time it was stopped. So he actually got a refund check after he got the slamming deal of 3 or 4% on the dollar.
Was that a
at the
wash, or
IRS.
did he end up getting money back?
No, he definitely got money back. He got a couple $1,000s back, and he was really, really happy because it was kind of like a forced savings plan at that point.
Yeah.
So in this case, this gentleman was living in Maine at the time that he retained me. And, Maine's really sparsely populated, so he kind of understood that he was going to have to find someone from somewhere else. And he ended up living in Mississippi.
The moral of the story is if you know someone, even in another state, Mr. Darrin T. Mish can probably help them. 888-GET-MISH.
Or getirshelp.com.
888-GET-MISH. Thanks so much for joining us this week for the IRS Solution Attorney Show. We really enjoyed having you. Please join us every week. We'll do our best to bring you a ton of value. This time this week, we're out.
We're out.